Good afternoon, everyone. I must profusely apologize that I stand between you and the lovely lunch waiting for you, so I apologize for that. But please bear with me. Nobody likes to talk about money, but we like to talk about money here at the Capital Link here in London. And my esteemed panelists may be known to most of you, but I think it might be very good and helpful just to actually highlight the background. I've got a mixed panel here today, looking at the same topic, but from two different angles, looking from the bank's angle, the one that everyone is used to, but also looking at the alternative financiers who have now trailing, but actually they are becoming very, very much sophisticated financiers. So firstly, here on my right, I will start off with Anastassia Tcherneva. She is the Global Head of Shipping and Intermodal Clients at ABN AMRO, which is obviously a bank that has been in shipping as one of its oldest sectors in their books. Anastassia is the member of the steering committee coordinating the Poseidon principles, with the decarbonization project being one of her prime interests. And obviously today, in the earlier talks of the day, decarbonization and the green and the blue economy are one of the highlighted matters and the biggest pressure that the shipping industry and the operators currently face, catching up with the regulations. Then next is Chris Conway. Chris is the Global Head of Transportation and Export Agency Finance at Citibank. He has held this role since August 2015, and prior to this assignment, Chris was the Global Head of Risk for Shipping and Offshore Logistics, in addition to being the Head of Risk for Global Industries in the AMA sector. Whilst at Citi, he's held a number of coverage roles in both shipping and the industrial sectors, driving very complex structured transactions from an early age in his career, in which the privatization financing for the UK ports and ferry business was an early example and quite fitting for the forum here today in London. I am then joined by Martin Hugger. I thought that actually the surname was a Hugger, so I gave him a hug, but actually it's Hugger. He is from Meerbaum Capital Solutions. He's a former banker in his previous life, but now is the one that's actually deploying the funds into the industry, switching the hats, knowing exactly what the industry wants and what the industry needs. Previously, Martin has focused on distressed opportunities in shipping for Greek and US investors, and prior he's been head of Greek shipping at Commerzbank, overseeing the merger of the Greek shipping portfolio of Deutsche Schiffsbank, Commerzbank, and Dresdner Bank, combined at the time to be one of the largest portfolios in the Greek shipping. And of course, we cannot talk about shipping unless we talk about the huge heavy player of the Greek shipping market. Last but not least is Mr. Harris Antoniou from Neptune Maritime Leasing. Harris is the founder and managing director of Neptune Maritime Leasing. He's held various executive management positions in leading institutions in the financial sector over the last 25 years, always focusing on debt and equity investments in the energy, commodities, and transportation sectors. Harris is passionate about technology, education, and digital transformation. And I'm hoping some of that knowledge today will come in within the ESG compliance, and how is that looked at and viewed at with the hat of an alternative financier here in the room. On the wider picture, really, we find ourselves at the moment at a critical juncture, not purely because of where the world sits at the moment geopolitically, but also with the various events happening worldwide. And no doubt all of these global factors are reshaping the ship finance landscape that we see here today. The Chinese economy, which is one not to be neglected and has never been neglected in shipping, but now that is more of a power force, is actually experiencing some slower growth. I think there is always a fear as to whether they are going to go into recession. Are they going into recession? How is that going to look like? And what does that mean for Europe? What does that mean for Europe? How does that affect the global trade and the shipping demand? However, at the same time, the European markets are actually grappling with the inflationary pressures and the shift in regulatory landscapes. And that affects and touches all of us, not just from a ship owning perspective, acting for the ship owners in my capacity as legal advisors, but also from the financier's point of view, on the risk management, assessments, and being so much closer to the shipping industry than they would have been before. Having those very difficult conversations and having that open book conversations where the ship owners are looking at the lenders more as being their partners in the business rather than just the cash that's coming towards that way. Talking about some of the statistics as to why ship finance is so important here in today's world, just to give you some background, as of early 2024, a year of turmoil, as we all know, the top 40 banks involved in ship financing held a combined lending portfolio of $284 billion, slightly up from 282 of the year before, reversing a downward trend that started in 2011. Asian and Australian banks have notably come into the market and having a much larger market share than they did before, and that's gone up from 43 to 45%. However, Europe still remains the largest ship finance region, accounting for 50% of the top 40 banks lending at $141 billion. So after these wonderful statistics and numbers that I probably will run out of ink with the zeros to it, I'll just open the panel actually to my esteemed panelists and just to take their view on what they think are the general trends that they are seeing in the ship finance and what it is the feedback that they are receiving from the ship owners and the various operators in the marketplace whilst having those ship finance discussions. Anastassia, if I may start off with you, please.
Yeah, so thank you for the introduction, Diana, and you've already mentioned quite a lot of relevant numbers, so I will try to be succinct in my answer. Buoyant shipping markets across the different sectors. In terms of relevance, European banks finance 50% of this global market, which I think makes us quite relevant. As such, given how buoyant the markets are and how cash-rich many companies are, in terms of financing, we are in a flattish market. What I think will be a tipping point will be the steepness of the decarbonization curve in shipping, which we inevitably will face in a couple of years from now, and or a downturn in the market, because we all know it's a cyclical market. And then it will start getting interesting. And maybe one last point, the beauty of this market, it's a global market, but we have a global regulator, which sometimes moving slow, but definitely has defined a good direction of travel, and I'm very supportive and look forward to addressing the challenges of being at net zero around 2050.
Thank you, Anastassia. And Chris, from Citibank's perspective.
Well, I think it's true to say that shipping loves a good crisis, and we've had a couple of different crises over the last 5 years, starting with COVID, then you've got the climate change crisis, which affects all of us, and the geopolitical events, Russia, Ukraine, etc. Not to say least what's happening in the Red Sea. All of this has driven demand in various ways, but it's quite clear now that the need to have ships that are fuel efficient, less carbon emitting, has driven a rush of new building orders, which in turn leads to finance opportunities. But I would agree with Anastassia that the portfolios are flattish because the companies, the ship-owning companies, have amassed lots of cash during the last few years, have been able to pay off debt, prepay debt, which means that banks will scramble to replenish their portfolios. So there has been a lot of new lending as well. We see that trend globally. We're not a European bank, but we practice here in London. But we do see that trend globally across all sectors. There are very few sectors that are not expanding.
Thank you, Chris. That is very true, because obviously the banks are looking at the shipping market quite closely and keeping a quite close eye on it. And then from Meerbaum Capital's perspective?
Yeah. Well, we had a good market now in almost all segments for a fairly long time. So for me, it feels like 2007 reloaded. The containers should be in a crisis. They are not because of Red Sea. And the product tankers have enjoyed a fantastic market, mainly because of market inefficiencies that come from the Ukraine war. And bulkers are seeing a good market because of, well, also inefficiencies on the one side and not so much of an order book on the other side. And at the same time where the ship market is in a very good shape, banks have issues to deploy their funds elsewhere because the economy in general doesn't offer that many opportunities right now. So what I'm seeing is too much money chasing projects that shouldn't be financed the way they are financed at the moment. And prices going down, risk appetite going up, and people forgetting that shipping is not always sunshine. So for us, the opportunity is that banks often write a dissertation before they come to a conclusion. But other than that, I see too much money chasing too few good projects.
Interesting, because actually in Macedonia, you know, the Greek Party Week, which we all love, earlier this year, there was a fear that the shipping market at the moment is actually riding a very good ride, pre-2008. And I don't know, Harris, whether that was the rumor that you also heard earlier this year in June?
Well, I mean, definitely we're in an upcycle, as you all know. Same for ship finance. In fact, I'm very pleased that we have a room completely full of shipping professionals eager to listen what's happening to shipping finance. That was not the case a few years ago. In fact, it used to be at the end of the seminar, probably at 4 o'clock in the afternoon. So now we're midday, so that means clearly that there's an interest, which is great. And it's also great because when we set up Neptune Leasing about 3.5 years ago, we did it because we saw what we call the $1 trillion opportunity. And I know that, we're adding zeros at the end of every sentence, as Diana said earlier. But the reality is that other than the financing or refinancing of the existing vessels, the existing fleet, which is about $1 trillion, by the way, in value, we have, as mentioned earlier, very clearly, the decarbonization drive, and that's going to occupy a lot of our time in the years to come. It's not a coincidence that already a large number of the new building orders are dual fuel, close to 50%, if I'm not mistaken, and that's going to continue. So we have a need to decarbonize, and that's no surprise. In fact, yesterday I was kind of scrolling through the LinkedIn sort of pages, and I'm not sure to what extent it's true or not, but for the first time, apparently, the Amazon is facing a major drought season, the second one in a row, and apparently it's for the first time possible to cross the border from Brazil to Peru because there's not enough water in the Amazon. So that's massive. And if I talk about my personal experience, I spent the summer in Greece. We have forest fires that are becoming a norm, not an exception. And I can go on and on and on about why this decarbonization drive is here to stay. So I think we're all going to, be challenged, but also benefit from this decarbonization drive. I agree with Martin that there is a significant supply of capital. In fact, the question has always been, is there enough capital for shipping? And I'm pleased to observe over the past 30 years that there's always been enough capital for shipping, as long as the returns justify the risks that owners are taking. And I'm afraid also, like you, Martin, that as we are in the upcycle, there is a question about our models and our ability to price risks properly.
So actually, on that point, is there any particular example that you would give that you have seen as being quite a nice structure being put in place with apparently, what everyone is noticing, from both sides, that there is a surplus of capital available for ship finance. Is there any particular structure that, you'd say this was an interesting one, quite bespoke, tailored to the circumstances, tailored to the fleet, to the ship owners? And, this is a question actually I'd like to ask all of my panelists because, it's educationary for us and for everyone to see, some things that are actually thought outside the box as professionals.
Look, I mean, to come up with, a case in point, for example, we started looking at the offshore sector a couple of years ago. The offshore sector has been completely unattended by the banks for reasons that we all know. It went through a massive downturn that lasted very long. We're talking about a 7-year hiatus in the offshore sector. So obviously that created a lot of headwinds for the participants, the companies, the banks, tremendous restructurings. By the way, it's not the first time. When I started my career in the mid-90s, that was the first sector that I attended, and we were going exactly through the same dynamics. So what you saw back then was that the companies coming out of restructuring, no banks, hence margins pretty healthy. So we saw exactly the same dynamics now. That's why we decided to move into it. I think it was the right pivot at the right time, perhaps a little bit late. My friend Elias there was a bit faster than we were in identifying the trends. But nevertheless, that's where you saw how capital that is less restricted by the regulatory arm is able to move faster and actually plug the gaps that one identifies in offshore. So a number of what we call alternative lenders or funds or leasing companies have done this. But now the banks slowly but surely and gradually will follow suit. So we have participated in that sector quite actively, and we will continue to do so.
And spotting the opportunities at the right time to plug in the gap. Martin, any prime examples?
We don't talk about specific things usually. Being a fund, you know you need to keep your secrecies. But adding to what Harris just said, who was, by the way, a legend when I joined shipping 25 years ago. You did a lot of things at Fortis at that time, counter-cyclical, which alternative lending now does. But in the meetings that I had with banks over the last one and a half years, almost every bank was asking, don't you think offshore is attractive? Shouldn't you move into that? And our response usually is we are mostly Germans, and the Norwegians say when the Germans enter offshore, it's time to leave, so we don't enter. But it's a lot of attention to sectors that are booming or that are on the way up. So that's basically it.
Thank you. That's a really nice perspective. And we mean everything in jest, by the way, here at Capital Link. Chris?
Well, just one idea that comes to mind about something being slightly different and unusual in terms of ship finance. You see various products like French tax lease and JOLCOs, and there's also the product that I'm most familiar with, which is export credit agency structures. But combining them, I think, is interesting, and one such deal that we did was to combine a JOLCO with ECA, which ended up providing the borrower with virtually 100% finance, and in a facility that was available through construction and then through maturity, and then again, if the option to purchase the vessel was exercised, that financing would remain. So it was quite a complex transaction, and I think in size it was quite interesting, but the most interesting feature of it was that we did it just as the Japanese tax laws were being revised and managed to get the entire scheme grandfathered. So the benefits to the individual tax investors were very significant, and of course that was reflected in the rates that were paid by the borrower on the loan. And remember that instead of raising equity at equity prices, they got 100% debt at bank lending rates, which is quite significant.
Wonderful. I mean, so obviously this is the prime example where the lender gets heavily involved in the actual project itself and not just detaching itself as being purely just the purse there sitting with the money and actually looking after the long-term care of the borrower and the needs that they have. Anastassia, anything from ABN AMRO?
Yeah, definitely. So my fellow panelists, they've seen a couple more cycles than I have. So I'm afraid I cannot. I can only. I believe in the cycle, but I don't have so many legendary deals to as they do. Something that we did recently, which actually won us the Marine Money Award for private placement, we provided a project bond for our client Eureka Shipping, which is a cement carrier with a long-term contract. The project bond has a maturity of 17 years. We managed to secure funds for 100% to cover the cost of financing. There were prepayments involved as well, and the pricing was very attractive. 250 bips on Canadian Treasury because we could use a structure with implied credit rating. I'm particularly proud of this transaction because it was tailor-made. We did not use our balance sheet. That we could cater for the needs of our client and still secure financing while looking at keeping their cost at bay. And yes, the details are all public.
Wonderful. I mean, as always, ABN AMRO is there together with their clients because, you know, they do have the expertise, just as, you know, Citibank have. They've been in the shipping sector for a very long time. They can kind of see what's going ahead. However, the alternative financing has become now very sophisticated, and it's, if we can use that in quotation in a good way, it's a real threat to the banks in terms of the financing. It'll be interesting to see where Neptune, Maritime, Leasing and Meerbaum Capital come in and say, why is the alternative financing better and what it is that they will offer that probably the mainstream lenders will differentiate themselves from.
Well, what do we really offer? We offer what the client wants. It's relatively simple. You can go to someone and he says, oh, I have this, that, and that product on my shelf, and you can pick one of those. And what we do is we ask the client, what do you want? What do you want to achieve with the project that you're presenting us? Why you want to do this project? Why you want to end up with it? And we listen, and then we see, can we add value? Is that a project where the risk appetite of my money fits to the risk that is in that project? And is the client willing to pay the price that we find adequate for the risk? And if so, we can move very, very fast. So I'm picking the phone up on a Saturday, and he gets an answer on a Saturday whether I think it's a project that I can convince my investors to put the money on the table and what approximately the terms will be. And if he then says, oh, that's okay, I think it's an opportunity that's worth it, then we move that forward and try to have by, say, Wednesday, a binding offer on the table. If he says, whoop, no, he goes elsewhere, like to you.
Well, thank you. I mean, you should. But Martin is correct in his observation about speed. So if you ask me, I would say three things. One is speed, second one is predictability, and the third one is continuity. And I think these are all essential for traditional shipping companies, especially in an era where for mostly regulatory and internal reasons is more complicated or difficult to actually get a bank to move very quickly. I'm not suggesting that there are no exceptions, and it's not a criticism towards the banks. On the contrary, I actually think that our relationship with the banks is symbiotic. I mean, we actually work very, very closely with a number of institutions from all continents, and we're very pleased for that. And in fact, the way I see ourselves is not as an alternative lender anymore, but it's as a mainstream product, because with the advent of ship leasing, initially with the Chinese companies moving in and making sure that everybody sort of understood the benefits of leasing, we created an asset class which is very broad and it's ubiquitous in a sense because I'm not sure if it's the majority, but a really large percentage of new building activities are funded by leasing companies. But we moved a step further. We said, look, we're not going to focus only on new buildings. We're also going to focus on second-hand ships. Because the reality is that second-hand ships still consist the majority of the fleet, and even the ones that are between, I suppose, 7 to 15 years of age, we're still talking about 40% of the global fleet. So if you don't attend to those vessels, that means that more or less half the fleet, especially if you move forward a few or 3 years, is left unfunded. And that's not good for the world economy, it's not good for trade, is not good for economic growth. And therefore, we said, okay, let's just make sure that those SMEs of the shipping world are still able to get access to funding. So we started, looking at even a single ship companies or help people start. Actually, I said once that, perhaps we should be considering ourselves the venture capitalists for shipping, for the shipping industry in a sense, because we help smaller companies achieve their targets. But as we moved along and our balance sheet grew bigger, of course, we started moving into other sectors like new buildings as well. So we offer the full range of product with spread, predictability, and continuity, because our background, of course, is many, many years in shipping and ship finance.
And in addition to that, what we also do is we are the people that enable the project to start, and then, because our money is very expensive, we get bank money in, and the blended yield that is then required is better for the client because it's lower, and we often help our clients to fulfill the requirements that banks have. So help them with the bureaucracy in a way. Smaller companies are often overwhelmed by the amount of paperwork that is required, and if you guide them, it's easier to blend that, and also on a portfolio basis you gain a lot of experience how to deal with banks that small companies don't have. So it's a cooperation between banks and alternative lending to a large extent.
So whilst flexibility and speed is of course very important to the ship owners and operators or anyone in the shipping world that is looking to raise some form of finance or capital, it is always important to also note, just like my esteemed panelists have just mentioned, that the relationship between the two sort of group lenders, if you like, is a symbiotic indeed, because they both understand the industry, they both understand the needs of the common client that they have. So it's the common goal, actually, to try and help them and actually help each other at the same time in the process. I will touch on a very specific topic, and this is actually very specific in the industry. I have noticed that myself as well. Last year, whilst representing a buyer, it was on a public tender, and we were struggling to understand as to why the shipyard was unable, or even the shipyard itself was actually unable and struggling to raise a refund guarantee. And this was a topic that came up in discussion between Chris and myself last night, and I believe that Chris has obviously seen that as a trend as part of the of his role in the export agency. Just by way of background, the UK government, this actually, in fairness, has been in existence since the late 90s. But in July last year, they introduced the UK government Shipbuilding Credit Guarantee Scheme, which basically what it means is that they will stand behind a shipyard and the credibility of a shipyard in new builds being carried out in the UK shipyards, or be that commercial vessels or yachts, or even a retrofit of the existing vessels in order to make them ESG and IMO compliant. And the intention for that is, of course, to be in line where Europe and the European Commission has been driving for quite some time, particularly post-COVID, which is the industrialization of Europe back again. So basically the industry being back into Europe and backing up the shipyards. New shipyards are being built, or at least explored for building every day in Europe. But what has been a very interesting turn of events is that whereas previously it was a buyer's market in choosing where to go and which shipyard to go and build their ships, now the shipyards are actually, in Europe at least, are at full capacity and has become a builder's market. So therefore, it's the builders who are choosing whether to accept the order and giving you the timeline to say, I will not put in your order for another 12 months, 6 months, or 18 months. And it was quite troubling for the markets when Mayor Werft earlier this June asked for the help of the German government to step in and help them with the refinancing in order for them to be raising working capital. There was nothing wrong with the shipyard in terms of the financial assessments when you're looking at it on the outside. Their order book was absolutely full. They were acting they had some of the really large orders on their books, for example, with the Carnival cruises, having some of their new cruise liners coming in. The issue was the rising costs because of the rising cost of the inflation, the continued maintenance of very high interest rates in Europe, and also in the US and the UK as well. Quite recently, we only had the first markdown of the interest rates by the UK Central Bank. So the question then became, were the shipyards capable of actually working on only that kind of capital structure, asking for 20% or 40% of the prices up front from the buyer, and then bearing the cost of all the orders and pre-orders they had to put into the yard? And obviously it's a bottleneck effect that came into play. And as Chris and I were discussing this last night, I just wanted to actually check with my panelists and get two different views. And I'll explain why it's two different views, because of course, ABN AMRO and Citi are based in Europe, and I know that they finance projects in Europe, but also outside of Europe as well, with the right buyer and with the right shipyard. So where there is the possibility of not getting 100% of the full amount on the refund guarantee, what does that mean for the bank in terms of their risk appetite? Are they still willing to provide the lending, or what kind of other risk assessment factors do they put with the shipyard? And probably I'll ask the same question to you, Harris, if that's okay, because Neptune Maritime Leasing now has a very heavy presence in Asia, and you are continually expanding. And you do, as an alternative financier, actually finance new builds. And I just want to see your view on financing new builds in Asia, and how does that compare to Europe? Chris, if I may start off with you, so we can carry on from the conversation last night, and perhaps, take your view to the wider audience on that.
Well, I think in the past, refund guarantees have been a requirement to protect the equity that's put in by an owner, or if a bank is prepared to make pre-delivery finance available, it protects that bank. Because normally it's not usual to find a ship lender who's also got a shipyard as its clients. Shipyards tend to have local banking relationships, and those local banks don't get involved in long-term finance. They always want to know that the post-delivery finance is going to be there as the takeout. But there are very few cases where we at Citi have had a relationship with a bank that has permitted us to be engaged in refund guarantees. We did design something for the cruise sector specifically. There was a French yard involved in that. The key differentiator, I think, there was that the French government had a 50% stake, and the yard was important for the construction of military vessels, just as it is for the other tonnage that they construct. So that was a very specific case. What you now see with the German yards, and to some extent the Finnish yards in the same family, is that they do have a weakness that has stemmed from an inability to make sufficient margin, but the working capital is the underlying risk here. Banks don't want to take that clean risk. There's no reason for a ship lender to take risk on the yard, which is a very high risk, and it's high because you only have to look at the rate of failure for that to be borne out. In Norway this year there's been at least 2 bankruptcies of shipyards. In Germany there have been at least 2, and more will occur likely. In Finland there was a few last year. In China they're opening yards to accommodate orders that have been bestowed on them by the likes of MSC and others. But what we are seeing is that the vessels that are in highest demand are these cruise vessels, which have a very high price tag. They're anywhere from $1 billion to $2 billion. That requires a lot of working capital. Now, you may argue that governments have a role to play in preserving these yards, and I would argue that if the yards are not kept alive in Lower Saxony, there'll be a lot of unemployment, because to construct a cruise vessel you need 30,000 odd subcontractors, and that supports a local economy. The German government found to its cost when they walked away from the shipyards in Wismar, the MV Werften, and the state of Mecklenburg-Vorpommern suddenly had its local economy very, very weakened by the bankruptcy of the Genting yard, MV Werften. So, there is a role that they can play, but of course they've got to play by state aid rules, which prevents them supporting 100%. And that's one of the reasons why the UK government, even though they wanted to support Harland and Wolff, were unable to do so because the requirement was for 100% support, and they were maxed out at 80, which is the EU rules. So that 20% clean has got to come from somewhere. And so the question is, who is going to provide it? And I think the lenders are really taking loan risk. The buyers of the vessels have equity-like risk, but they get equity-like returns. When those ships go into operation and start generating revenues, they're like cash machines. So I think that there is now going to be more and more pressure for buyers to step up to that clean risk. And I think it's correct that they should.
That's right, because obviously it becomes a risk-sharing exercise now between the lenders and the buyers, because the lenders are not saying we will not come in and finance you. It's just that they are recognizing the risk that, the shipyards could go bust, but in reality, the risk of the yards going bust has always been there. It's not anything new. It's just that what's actually happening is that whilst the UK government guarantee scheme is only up to 80%, you have the Chinese and the Korean banks that actually go all the way to 1995. And I know that we're running out of time for a little bit, but it would just be interesting to hear Harris's perspective, who actually does fund new builds as an alternative financier, probably with 100% of refund guarantees in place or thereabout?
Well, we need to start with, we have not experienced what you described earlier, perhaps not in Asia. Typically, the yards, banks do provide refund guarantees, and there are actually no payments to the yard unless a refund guarantee has been issued. So unless all the payments are covered by the refund guarantee, we're not going to engage. That's pretty clear. On the other hand, because you talked about Europe, I think it's a question of industrial policy. We've seen a revival of the interest in the shipbuilding industry in Europe, in different countries. I think it's a combination of commercial interest, because clearly there's not enough shipbuilding capacity globally, but also of security interests, because people realize that you need to have a vibrant, shipbuilding industry in order to cater for all the other equipment or ships that they're able to produce. So I think this will continue. And Mario Draghi came out very clearly a couple of days ago, and he said that we need a package of 800 billion to revive the European industry as a whole. So I suppose that must be including the shipbuilding industry as well.
Well, thank you very much, and it's been an absolute pleasure having everyone in the room today and my esteemed panelists. But just to tell you how much ship finance is important to the shipping industry and is here to stay, and is here to stay for a long time. The current global fleet value, I'm going to finish on statistics. I cannot be living in Britain and not finish with one. Currently is valued at $1.5 trillion, of which $600 billion is under ship finance combined, alternative and mainstreaming. Thank you, everyone.